Simon Mariner is at St George for you. Simon, amidst all the exuberance, it's time to sort of take a little bit of a step back to look at those GDP numbers and really do, I guess, ponder how artificial the print is, given it is so much driven by stimulus.
Yeah, indeed. The world's consumed by looking at those GDP figures this morning. As you just mentioned, the world's largest economy posting a GDP result of 3.5%. That's annualised for September. The market was expecting 3.2%, and believe me, people spend many, many hours poring over the GDP puzzle to try and get that number right. So a little bit outside or way stronger than expectations. Personal consumption, probably the key driver for that GDP figure. As you mentioned, a lot of stimulus in the economy there. Overall, about 70% of the US economy is driven by personal consumption. So we're seeing massive stimulus there, low interest rates. The Cash for Clunkers program, they've still got an $8,000 tax credit for first home buyers. So, it is a very good question to have a look about how much of that GDP result, which is the first positive result that we've seen since really Q2 in 2008, how much is real and how much is artificial.
Simon, does the White House know what it's talking about? We had an official overnight saying we anticipate this is the turnaround, and then almost in the next breath said the US will continue to lose jobs. Seems that one cancels out the other directly.
Look, a very, very good point, and I suppose a bit of a basket case, the term comes to mind. It's a very delicate balance what's going on there at the moment. We're seeing these very strong GDP results. We've seen in recent weeks some good corporate earnings, or if not good earnings, some good corporations showing they're able to run their economy more efficiently. Yet, we're not seeing anything about the stimulus being aggressively reversed yet. Certainly the Federal Reserve is not using any language along the lines of actually tightening or raising the target rate anytime soon. So a very delicate balance there going forward. And I suppose what they've got to really try to do is not to stifle or choke any of that confidence that we're seeing coming through overnight.
All right, tell me though about the rally in equity markets. You see it being sustainable, or do you think when we get some more consumer confidence numbers out overnight tonight, there might be the reassessment that we're endeavouring to bring to bear on things even now?
Yeah, look, amazing result in stock markets in the US overnight, and we'll see if that is infectious enough to flow over into our hemisphere today. The S&P 500 up 2.3%, the Dow up over 2%. I think that's the biggest daily jump in over 3 months. Really what it's telling us is that regardless of the comments we're hearing from the White House and the other rhetoric, US investors and global investors perhaps are very confident. They're confident in the fact that the US economy is moving in the right direction. I suppose what they were beginning to fear was that this 7-month rally that we've seen in equities, was it outpacing, was it outstripping the economy's prospects for growth? And I suppose, they've voted with their feet, they've jumped in there, and what they're saying is they're confident that it hasn't.
End of month flows as well. I guess we've got to be mindful that it's kind of close-out territory. That could, I guess, bring in some hefty rebalancing and perhaps distort maybe the moves a little bit, the market moves.
Yeah, certainly could. But I think confidence abounds, and it is a key driver of what investors want to do in all sorts of different markets. If we sort of broadly split the US economy up into sort of 3 sectors, the finance sector, doing okay. There's plenty of liquidity there. They can get some funding. The corporate sector or the business sector, we're seeing some good results or some efficient results. But for my mind, the household sector, I think, probably still feeling a little bit of a pinch, as you've alluded to, the jobs data earlier today. Also the fact that, personal consumption really is the key driver of that GDP figure. The household sector, there's still a bit of an unemployment on the radar. I know that we, dwarfed or forgotten in all this data there was some initial jobless claims numbers yesterday. They moved 1,000 in the right direction, but that was still 520,000 people signing on for initial jobless claims. I'm sure there's plenty of struggling homeowners out there as well. So, all in all, they're not sort of firing on all cylinders there. And I think if they can keep this confidence running hot, then that household sector might sort of pull into line behind the rest.
Aussie dollar trading as high as 1 point above 91.82 off the back of those figures. Where do you see it hitting the next 24 hours?
Wow, all this volatility, it does certainly make for a very good market. We've had a 2-cent or a 200-point range in the Aussie in the last 24 hours. We had that home sales data from the US and then driving it down. There's a bit of pessimism, but certainly risk appetite abounds now. Look, it is going strong. It did struggle to sort of get up over that 93-cent mark. You know, but it does seem to be well supported. It had a little dip below 90 cents, but it's come back up straight away as well. The other thing I think perhaps driving the Aussie dollar is the euro. The euro's put in a bit of a stellar performance over the last 8 months or so. It cracked its December 08 highs and has just sort of kept going, and I'm sure that's probably dragging the Aussie dollar along behind it as well. So look, I think my personal view and the bank's view is onwards and upwards for the Aussie dollar, but you know, if the last 24 hours does show anything, you've got to be a bit cautious because it can move around quite quickly.
Indeed it can. Simon, great to have had your analysis, and have a good day.
You too.
Appreciate it. Simon Mariner there from St George. We're very close to a new trading day now. The SPIs, as promised, coming out with a reset there. Actually,